Welcome to Wealth. I'm Allie Canal, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, investors turn slightly more risk off as conflict in the Middle East enters its fifth day. A portfolio manager shares tips for managing volatility in just a few moments. And Homebuilder Sentiment falling to its lowest level since 2022. We speak to an industry expert about the housing outlook. Plus, looking to vacation on a budget? Some travelers are considering swapping homes. We hear about the latest trend from the founder of Kindred later on in the hour. But first, we take a look at some of the market action 90 minutes into the trading day. You're seeing stocks fall across the board as investors navigate escalating conflict in the Middle East, weak retail sales data, and the Fed meeting kicking off today. Joining me now is Matt Stuckey. He's the Chief Portfolio Manager for Equities at Northwestern Mutual Wealth Management. And Matt, markets seem to be taking a breather today after yesterday's bounce back. How do you think investors are processing the latest risks here? Not just tariffs and inflation, but now that escalating geopolitical headwinds are on the table, that's another risk that we're going to have to deal with.
Well, good morning, Allie. Thanks for having me back. There is no shortage of uncertainty as it relates to financial markets. But the good news is that financial markets have always been pushing through some form of uncertainty in one form or another. Today, it's tariffs and geopolitical uncertainty. But just think about the uncertainty that the U.S. economy navigated in the form of COVID just a few years ago. And so while uncertainty is constant, market returns are likely to be favorable for investors over the long term.
So how are you advising clients to navigate this volatility, diversify their portfolios, and still be able to capitalize on the momentum in certain stocks out there?
Sure. A variety of asset classes do offer valuable diversification opportunities. Today, it's not just the TINA trade. Fixed income does offer income return that is above and beyond the rate of inflation today. And so that's a useful tool for diversification purposes in investors' portfolios. Additionally, international equities have led this year in terms of the equity landscape. The reason being is that the dollar's well off its highs, and if that were to continue, you would expect international equity leadership to continue. And thankfully, if valuation is a concern for some of your viewers, those are priced at a significant discount to kind of where they typically trade versus U.S. equities. And so there is the valuation catch-up potential in the international markets as well. And so a variety of different opportunities for investors to embrace in different parts of their portfolio to really highlight diversification as a way to navigate this uncertainty.
You mentioned the TINA trade. For those that are unfamiliar, what is the TINA trade, and why do you think that's not the only game in town anymore?
The TINA trade, you have to go back into kind of post-global financial crisis into a period of, when the Federal Reserve kept interest rates near zero. There really wasn't, a return element to fixed income that investors found palatable for their portfolios. And so, TINA stands for there is no alternative. And the only alternative to kind of the low interest rates that were out there were equity returns. Today's environment is different. The 10 years today is at 4.4%. Shock interest rates up or down 100 basis points, and more than likely you're going to have a positive return outcome and into double digits if you do get an interest rate move 100 basis points to the downside. And so, that's what we're talking about. It's not just equities anymore. There's return opportunities across the equity landscape, but also in fixed income as well that investors should embrace.
We've seen weak sentiment in the stock market, yet equities are at or near records. How do you view the V-shaped recovery we've seen since the April lows? Has the strength of this rebound surprised you?
I think if you put this correction in context, it shouldn't surprise investors too much. And the reason being is that, there's only a few kind of categories of, either macroeconomic or geopolitical variables that causes equities to move lower. One is sharply higher interest rates, two is sharply higher unemployment rates, and three is some sort of exogenous shock to the economy. We didn't have higher interest rates heading into the sell-off that started in April. We didn't have higher unemployment that went into the sell-off that started in April. What we did have was tariff risk enter into the foray, kind of with the crescendo of that being April 2nd. That shifted about a week and a half later. And so, the cause of what was pushing equities down has turned into, something more palatable for the economy to digest. And so I think that's why the rebound has been so sudden, is that it wasn't a type of correction that was kind of due to higher rates or due to higher unemployment.
Do you think the S&P 500 has more room to run from here?
Maybe in the short term. I think what's weighing against the longer term, intermediate term in terms of kind of how we view the attractiveness here is just the starting valuation. On a blended forward basis, you're paying 22 times forward earnings for the S&P 500. But for the good news and the silver lining for investors is that earnings estimates are on the rise again. That matters for equity returns. And so, we just are pushing through the end of Q1 earnings, and that has come in better than expected, helping to grind higher, those earnings estimates, which is a powerful kind of short-term momentum driver for the market.
And the Fed meeting kicking off today, we'll have that press conference, that decision happening tomorrow. You seem to think that the Fed could start cutting in July. Consensus is around September. Do you think Jerome Powell is going to telegraph at all tomorrow when it comes to when we could see potential easing?
No, I think Chairman Powell probably won't outline specifically when he wants to start easing, but I do think he's going to talk a lot about two-sided risks to the economy. One from moving too soon and having inflation moving higher. The other side being waiting too late and having unemployment move higher. It's a delicate balance and it's a difficult job. One thing that has been a positive is if you're in Chair Powell's seat, though, is if you look at the last 3 or 4 months of inflation data, it's been nearer or below actually the Fed's inflation target. The last 3 months of core CPI annualized is about 1.7%. And so that's the starting point for when some of these tariff related CPI prints are likely to come into the data. So the starting point, I think, is giving a little bit of comfort if you're Jerome Powell here.
Matt, thanks so much. Appreciate your insights. Now time for some of today's trending tickers. We're watching Spotify and Yum Brands. And joining me now is Market Domination co-host Josh Lipton. Josh, thanks for being here for our trenders. And first up, we have Spotify, Pivotal Research Group, raising its price target on shares to $900. That's the highest on the street. Analysts there point to Spotify's victory in the audio streaming wars thanks to its superior user interface and recommendation engine. Pivotal also expects Spotify's average monthly listener to rise from 700 million to 1 billion eventually. And I gotta say, it's been so interesting to cover this company, to watch this stock's rise, especially since the lows that we saw in 2022 were so dire. And now to see just this insane meteoric rise to the upside here, bouncing off those lows. And according to Pivotal Research, still more room to run here.
Pivotal says the fight's over, right? We have a victor when it comes to global auto streaming wars. They say the company has won it. How do they do it? Pivotal says they talk about best-in-class user interface, the recommendation engine. They say audio streaming will still appear underpenetrated globally, allowing them to take price and still generate solid subscriber growth. They call this a powerful combination. To your point, Allie, the stock has been a monster. It is already up around 60% this year. And most analysts, by the way, do agree with Pivotal. Most say this one, even after that kind of run, still a buy here.
Yeah, similar to the Netflix playbook, too. We've heard of Spotify as more of a defensive name, especially if the macro weakens from here. We saw this pullback in retail sales, but folks are still going to be listening to their music and their podcasts, and it's a relatively cheaper alternative.
Yeah, Pivotal says there are risks you need to think about before committing capital here. They talk about investors need to think about including concentrated power of the music labels, they say, with 90% of their largest cost item, that would be music programming, controlled by just 3 or 4 players. They talk about possible content cost inflation, but bottom line, they're believers.
Yeah, valuation always a concern too, as we continue to see this stock chuck along higher. Next up, Yum Brands, the parent company of KFC, Taco Bell, and Pizza Hut, announcing its new CEO today. Chris Turner, the current chief financial and franchise officer, has been unanimously selected to assume the role starting October 1st. CEO David Gibbs will remain as an advisor until 2026, having indicated 3 months ago that he intends to retire in the first quarter of that year here. And Turner, he joined the company in 2019. Before that, he held senior roles at PepsiCo, spent over a decade at McKinsey. He was able to expand Yum's digital footprint, the value menu, which we know continues to be big drivers here for a lot of these fast food names.
Yeah, so KFC, Pizza Hut, Taco Bell, that's the brands we're talking about. Bloomberg does note Yum is expected to report same-store sales growth in the 3 months through June 30th, which would extend, they say, this 2-quarter streak powered by you guessed it, Taco Bell. They do note struggles in other brands like Pizza Hut, Allie. Those are expected to continue. The stock has not really done much. I mean, if you pull up a chart, it hasn't done much this year, hasn't done much over the past 12 months either. And most analysts on the street, despite that, you're looking at about 70% actually think even now this is still a hold here.
Yeah, Taco Bell has consistently been a standout here. When
you know why? Because it's delicious.
It is
That's
delicious.
Why, yeah.
You don't feel too good the next day, but in the moment.
No, I feel great.
Okay, that's good to know.
I could eat my weight in Taco Bell.
All right, we should have brought Taco Bell on here for this segment.
Starving.
But as you alluded to, Josh, Yum brands are only up about 5% since the start of the year here. Thanks so much for joining us for the trending tickers, and you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up, we dive into what this morning's disappointing homebuilder confidence data signals about the state of the housing industry. That's next on Wealth, and later in the hour, we get a read on the travel industry with the CEO of Marriott International. You don't want to miss it. Confidence among U.S. homebuilders in June hit its lowest level since December 2022, as high mortgage rates and policy uncertainty hit would-be buyers. With more on the landscape for homebuilders, we have Katie Hubbard, Walton Global's Executive Vice President of Capital Markets, joining us now. So, Katie, there was actually an expectation we would see sentiment rebound here. Clearly not the case. What does this tell us about where homebuilders and really the overall housing market stand right now?
Yes. Hi, Allie. Thanks so much for having me. So homebuilder sentiment dropped to 32 from 34, went down slightly. We were expecting it to increase. However, that is surveying over 400 homebuilders across the U.S. And our clients, Walton, we have public homebuilders as our clients, and they're definitely not seeing that negative sentiment. But if you're Bob the Builder and you're not able to have the same really tools in your toolbox as public builders buying down mortgage rates and offering incentives, then your sentiment is definitely down because affordability and just consumer confidence is keeping people on the sidelines.
And overall, the outlook here has been cautious, and you pointed to some bumpiness in the home builder data over the past few months. What will it take to reach that full rebound? Is it more clarity on tariffs? Is it a step down in mortgage rates? All of the above?
It really is all the above. I mean, right now we're seeing an all-time high of 27% of people aged 25 to 34 are now on the sidelines. We have 650,000 people in that age group that have, since 2023, moved in with their parents or grandparents, and another 250,000 25 to 34-year-olds have moved in with roommates. So they're really on the sidelines waiting for rates to come down, just that consumer confidence. And so it's keeping people on the sidelines. But the fundamentals of demand, the demand is there. It's just what we're seeing is that the large public home builders, it's not as much of a problem for them on the on the home builder confidence. They're going to build through this cycle. They've learned in past cycles that if they pull back or they lose any land positions, the demand is still there, so they're going to go through it. What's happening, though, is smaller builders that can't really compete, they're probably going to be the ones that are turning in the keys, and they're going to be selling to the large public home builders. But we really need, rates to come down closer to 6. They're now today at 6.72 on the 30-year fixed, and that's just keeping people on the sidelines.
So demand is still there, but where are you seeing the biggest cracks? You mentioned some of that younger cohort of buyers. Is it more entry-level buyers that are staying on the sidelines at this point?
It really is, but if you go into a public home builder community, they will buy down your mortgage rate. And so if the mortgage rate is the issue and you go into one of those communities, they're going to do anything that they can. Even going to 0% margins and really building the house for practice to get that home sold. So it's really pace over price for public home builders. And then on the flip side of that, the positive is you've got 55 plus communities are doing very well. We've got 12 million people that are going to be hitting that 55 plus age bracket over the next 8 years. And that's where the wealth is. There's $112 trillion in wealth locked up in people born before 1970. And that group of people, they're really going down, selling their houses and going into smaller houses. They want to go to master plan communities with amenities like pickleball courts and, wealth and health and wellness. And it's not like, our grandparents, it's a different type of generation at that 55 plus where they're healthy, they're wealthy, and they're tech savvy. And so if you're a builder that can build amenities to that genre and that group of people, then you're also going to do very well, similar to the entry-level home builders. But if you're in that middle bracket, building 5,000 square foot houses on acre lots, those are the groups that are really struggling.
I got to have those pickleball courts. And what about regionally? Are there certain pockets in the country that have higher demand, or that maybe there's some more pricing power there?
Yeah, absolutely. You're seeing just affordability is really the key. So people are going to markets like Sacramento, Portland, Minneapolis, where there's just affordable homes, and that's really what's driving the places that are still doing well. I mean, places like New York and Boston, people are just priced out.
And then tariffs, obviously the big TBD factor this year. What policy moves, whether fiscal or regulatory, would really help move this housing market along?
Yeah, so our builder clients were really expecting about a 6.8% increase in materials. Right now, they're reporting only a 2% increase. And so that has been a positive, but deregulation is going to really offset any tariff increases. So they're looking forward to deregulation with the current administration that will drive down prices, because about a third of the cost of a new home is due to red tape and overregulation.
And given your vantage point as a land investment firm, are builders showing more interest in grabbing that land now to really feed some of that demand that remains out there, or do they want to wait for a little bit more clarity?
Absolutely. There is a land grab to control the land. So if you're able to really scale your operations, secure capital, and then option your land, doing institutional land banking like Walton, you're going to be in a better position as you build through the cycle, because on the other side of it, when you have the land that has not only the amenities, but the zoning, and you have the ability to build on it, those are the builders that are going to do better on the other side. And they understand that. So in the last, the great financial crisis, the home builders that dropped their land, and on the other side of it, they wish they hadn't had. They've learned, and that's really the large public builders are the ones that are out doing the land grab, and they have the capital to do that.
All right, we'll continue to watch the evolving landscape, quite literally, of this housing market. Katie, thank you so much. Appreciate your time.
Thanks, Allie.
Coming up, we check in on the state of travel with the CEO of Marriott International at Cannes Lions. That's all on the other side of this break. Let's get a quick check on markets here. We're seeing stocks continuing to edge lower today as investors digest the latest escalation in Israel, Iran. Obviously, that's top of mind as geopolitical risks remain a key concern here. You're seeing the Dow off about 0.1%. We are off of the session lows. Nasdaq Composite off about, let's call it 0.4%. The S&P 500 off 0.3% here. We're also continuing to watch the price of oil. Oil futures are rising today. Over the past 3 days, you saw a dip happen yesterday as it was seemingly the narrative out there that escalations were coming down here, but we are continuing to track up in prices, nearing some of those levels that we saw on Friday. We are up around 3% here, trading just below $74 a barrel. Yahoo Finance executive editor Brian Sozzi is out at Cannes Lions this week, and today he got a chance to sit down with the CEO of Marriott International to discuss domestic demand, international travel, and the role of AI in the industry. Let's listen.
What are you seeing in terms of demand for hotels this summer?
Yeah, so we just did Q1 earnings. The RevPAR was up a little over 4% globally, little more modest in the U.S., about 3.3, almost 6% internationally. And it's a good blend of both occupancy and average rate, which is encouraging for our business. Virtually every region was up in RevPAR. China's relatively flat, but that's even an improvement over some of the drop-off we'd seen in China the prior couple quarters. So what it tells us, you and I have talked in the past about the fact that when we look at consumer spending data, we see this continued, I think, consistent shift away from consumption of hard goods towards investment in travel and experiences, and the demand patterns would suggest that's continuing on a global basis.
There is some recent data out from, I believe it was STR. They track, of course, the hotel industry, that later this summer we might see some slowing in occupancy. Have you seen any of that?
Not really. I mean, but I'll give you one caveat. Group has been the strongest segment. In Q1 globally and in the US, we saw group RevPAR up 8%, so really strong, whereas business transient and leisure transient were up about 2%. The one caveat, we've got much more visibility into group because of the longer lead booking time. For transient, whether it's business transient or leisure, the booking window is only about 3 weeks. And so today, am I seeing any of the softness that you described? No. But we've got to be transparent. That could change given how short that booking window is.
Is international growth still outpacing U.S.? And I'm not just asking you that because we're sitting out here,
Right.
here in France, but I mean, is that what you're seeing in business?
It is. I mean, particularly the Asia Pacific, excluding Greater China market, they're seeing double-digit RevPAR growth. Many markets in the Middle East are quite strong. We expect a strong leisure summer here in Southern Europe. So yeah, I think international continues to be a bit stronger.
And the Middle East region is in another conflict here. Are you seeing
Sure
any
is.
slowdown or weakness at all in the numbers?
Not yet, but again, you got to think about that booking window. The thing that's so interesting to me, as I think I heard you in one of your shows talk about the fact that a few months ago, the U.S. reported a 52-year low in consumer confidence. And had you said to me a year ago, the U.S. is going to hit a 52-year low and consumer confidence is so impactful to your business, what do you expect to see? I would not have been talking about mid-single-digit RevPAR growth. I wouldn't have been talking about the fact that in Q1, we signed more deals than in any Q1 in our history. In 2024, we signed more deals than in any year in our 98-year history. So what that suggests to me is, of course, the consumer is concerned about economic headwinds, about political and socio-political instability. But because they continue to prioritize travel and experiences, maybe we're floating above that a little bit.
Take us through the Citizen M acquisition.
Sure. So as you know, as we've grown the portfolio, I think we've had a really thoughtful blend of organically developed platforms like Moxie, like Autograph Collection, and M&A deals, like all the way back to Residence Inn, Ritz-Carlton, AC, and that'll continue to be the way we think about growing the portfolio. Citizen M, we thought, continues to build on our industry-leading lifestyle portfolio across quality tiers and across price points. We think it slots in nicely above Moxie, below AC, and among the things that really attracted us, they've got a great footprint in primary gateway cities around the world, and they are very tech forward. So if you look at what they've done with check-in kiosks in the front desk, you look at the in-room technology that they've incorporated, I think there's a lot of learnings for us. So we're quite excited about it.
I've seen, of course, AI is a hot topic here on the ground here at Cannes. I remember when checking into your room via your phone was a big deal, but
Right.
How are you putting AI into practice into the hotel experience? Whether it's to find, cost efficiencies, I mean, it's hard to find workers for some of these jobs, or just to make the experience better?
So philosophically, we understand it's going to be a big and growing part of our business. We've created something called the Marriott AI Incubator, where we're running all sorts of proofs of concept. But I think you hit on both the points. At the property level and above property level, there are some work streams that are going to be enhanced significantly in terms of efficiency through artificial intelligence. Similarly, in terms of the guests, our guests are becoming more sophisticated. They know exactly what they want. And so in terms of trip planning, in terms of helping them navigate a global portfolio that's almost 10,000 hotels now, we think AI is going to be an enabler in terms of speed. The way I talk about it internally, whether it's AI or other technology platforms, what they'll do for us and for our associates is create capacity. Thankfully, ours is still a human connection business, but if through the use of technology, I can create 30, 60, 90 seconds of capacity for my front office agent, rather than looking at a screen to look you in the eye, figure out why you're traveling, if you've had a tough travel day, maybe do something to enhance your experience, that's maybe the piece of technology I'm most excited about.
That was the Marriott CEO, and our thanks to Brian Sozzi for bringing us that interview. Coming up, we learn more about the high cost of moving cities. That's next on Wealth.
All week, we're giving you everything that you need to know about paying back your student loans. There are so many options out there, but income-based repayment, standard fixed monthly installments, and even potential loan forgiveness are some of the main ones. So, how do you know which payment plan is best for you? Here to break it all down, we've got Jan Miller, the president of Miller Student Loan Counseling and Consulting. Great to have you here with us, Jan. So what are the first things that you should do before you even start looking at potential payment plans?
Immediately you want to start and create your account for both the loan servicer and for federal student aid, which is going to be your FAFSA, studentaid.gov. And that's because you may have to use both of them. So your loan servicer handles deferments, forbearance, payments. Federal student aid is going to handle applications for income-driven plans and forgiveness programs.
So let's lay out a few key scenarios here. Many borrowers may find themselves in. The first one, perhaps, if you have federal loans and you work for a nonprofit or a government agency, what payment plan might be best for you?
Yeah, so right now, of course, a lot of change with payment plans due to the recent court injunction on the SAVE program, and of course the new Republican bill coming. However, the income-based repayment plan is likely going to be the best option for public service loan forgiveness. And whenever you hear the term income-driven repayment, that refers to all plans, SAVE, pay-as-you-earn, revised pay-as-you-earn, ICR, IBR. The one that you want is income-based repayments, because that one you will certainly qualify for if your income is low enough.
Now, what if you have federal loans and you owe way more than your annual income?
Right. So if you don't work for a nonprofit, you still want to pursue income-driven plans, because your total out-of-pocket costs, even if you're considering potential tax consequences of the forgiveness at the end, is still going to be less if you make payments, lower payments based on your income until the loan is forgiven, which forgiveness is still a real thing under that program. Additionally, it's going to increase your cash flow in the real time, so your payment's going to be lower. So you get to have your cake and eat it too, a lower payment and lower total costs on the loan if your debt is that much more than what you make yearly.
Now, what about someone with federal loans, but their income makes payments pretty affordable?
Well, again, if your credit's good and you're in a good position financially, and you can afford your monthly payments, you can afford, a payment of around 1% of what your balance is, then you want to consider a refinance and paying the loan in a more traditional sense at that point, because you hopefully can get a better interest rate, especially as inflation cools.
So there is this scenario as well. If a borrower has just private loans, what are the options there?
Just private loans, first of all, it's going to depend on your lender, right? So if you have Sallie Mae, they're going to be more flexible. They have a greater amount of forbearance. They have rate reduction and term extension programs that you can apply for. And they'll usually have additional options for you. And of course, one of the tricks is if you can't get any help from customer service, let the account go a few days past due, and the collections representatives will have a greater amount of authority to give you options if you have to do that. They don't report to credit until you're 45 days, so you can avoid that. If you have other, other lenders such as Citibank or Citizens Bank, you have less options. It's more like a traditional loan that you're going to owe a bank. And if you can refinance it, that's fine. But we often say in the office here that if you qualify for refinance, you probably don't need it or have a student loan problem. If you have a problem, then you probably don't qualify for it, because it'll show up in your financials. But if you can refinance, do it. If not, you're going to be stuck with that payment unless in severe or last resort situations you can't afford your payment, at which point then you can try and negotiate settlements or try and work out temporary payment arrangements with the lender themselves, but your options are more limited.
How aggressively should borrowers be when paying down that student debt?
Well, and again, it depends on what their other financial objectives are and whether they qualify for one of the forgiveness plans above. So generally speaking, if you can afford your payment easily and even afford to pay extra, and you don't qualify for any of the forgiveness programs, none of those make sense for you, then certainly be aggressive. However, federal student loans are some of the most flexible loans that you can find. So if you have other higher financial priorities, or let's say a higher percentage interest rate credit card or other loan, you can use or leverage federal student loan repayment assistance to help you accelerate your payment and more aggressively pay other debts. So it does depend on your financial situation.
Now, what if something happens and a borrower is unable to make their monthly payments?
Well, they have a lot of options, more so with a student loan, a federal student loan, than any other type of debt really in the world. Certainly, of course, you want to try and see if you can qualify for public service loan forgiveness or any of the income-driven plans and lower your payment that way. Remember that you can often use your prior year tax return as proof of income, which might be lower. So especially if you just came out of school, your payment may not reflect immediately what your income is right now. So it can be a big benefit for you. If you don't qualify for those plans, then you can look at other options like, you can have, forbearance, deferment, things of that nature. You might qualify for more forbearance than you realize. You get up to 3 years, 1 year at a time, pretty much no questions asked. The rep might try to talk you out of it, but you'll eventually be able to get that done if you need to. And of course, if you have specific deferment situations, military, economic hardship, unemployment, those work as well. And then if those don't work, then you can extend your term. So federal student loans are unique in that you can extend your loan term without meeting any credit criteria. So if you're in a 10-year term, which is what most loans will default to, you can extend up to 25 or 30 based on how much debt you have, and that will lower your payment. And even more so, if you consolidate your loan, it'll restart the amortization schedule from scratch from the beginning and extend your term. So a federal student loan consolidation, if you haven't done that or you're able to do that, can lower your payment as well. If that doesn't work, then you have to get more creative. But there usually is a solution, almost in all circumstances, if you know how the system works. You can delay your payment or lower it based on whatever your situation is. And with federal loans, you can't negotiate settlements very easily. The most they'll usually take off is 10 or 15% of your debt. But with a private loan, if you have to, again, you don't want it. You want to pay it and do something because the federal government, as we're finding out, has extraordinary, ability to collect if they want to, you see them taking Social Security now.
Many LGBTQ plus families are packing up and leaving cities as policies change across the country. This move, though, can be pretty costly. Here to break things down are John and David Ottenschneider, the host of Yahoo Finance's Living Not So Fabulously podcast. So, David, let's start with you here. What's the average price tag for a move like this?
Sure, definitely. Thanks for having us, Allie. It's great to be back. Unfortunately, the emotional cost of uprooting your family for life and safety is a bill that no one should have to pay for, especially in the freest country in the world. But the reality is that some families are moving, and that the price tag does depend on the size of the family and how many belongings they have. Our friend and colleague Jake Skellhorn, who's a financial advisor in Jacksonville, Florida, is recommending to his clients that they set aside anywhere from $40,000 to $95,000 for the move. And as your previous guest talked about from Capital Group, Katie Hubbard, the cost of housing today is one of the biggest costs. So the idea of moving to a new city and having to pay for a more expensive place to rent or a more expensive home, especially considering interest rates, that's one of the big expenses. But the actual moving expense can cost anywhere from $10,000 to $20,000, let alone things like a job loss or job disruptions and how that can affect your income, as well as things like housing transition, legal and administrative costs.
Interesting. And John, many big cities carry a higher cost of living. So how do you advise a family to prepare for that financial shock?
Yeah, as a couple who's lived in 2 different countries and 4 different cities over the last 5 years, we know how to adjust our cost of living accordingly. So we have 3 tips here for folks. The first is to do a pre-move audit. Get a crystal clear understanding of what the housing, taxes, healthcare, childcare, all those line item budgets that you have in your budget currently, what they'll cost in your new city. There are sites like Numbeo and bestplaces.net that are great resources to rely on. And then when you think you have an understanding of what that's going to cost you, try a practice run for maybe 1 to 3 months to see, can you live within those constraints? And if you can, if it's not necessarily feasible for you, how do you have to adjust your budget accordingly? Or do you have to think about maybe multiple additional sources of income? And then number 3 is to know your enough point, right? Moving to a safe location doesn't mean you have to go and live beyond your means, even in expensive cities like New York, LA, and San Francisco. A modest life in a safe space is far more better than a lavish one living in fear.
Right, some great tips there. And you guys recently had Don Lemon on your podcast. He's former CNN anchor, now host of The Don Lemon Show. He spoke about the money advice he'd give. Let's take a listen.
Save some money. Put some money away. Invest in your money. Don't invest in the market if you can. And don't try to keep up with the Joneses. We always try to keep up with the Joneses, and everybody's out there, they're buying and they're fabulous and they love luxury and all of that. I am not, one thing that has saved me is that I don't really care about luxury. I don't care about brands.
And David, Don advises against keeping up with the Joneses. So what advice would you give someone to stay in budget, especially if they move to a new city, they're trying to make new friends and ultimately have some fun?
Definitely. We all appreciate this idea of trying to enter into a new group of friends and wanting to impress people. But I think the important thing is, first of all, start by tracking all of your spending in this new location. We love the free Empower Personal Dashboard app because we connected our accounts to that, and it always helps us keep a pulse on where how much we're spending. I think the second thing here is to make fabulously frugal your brand, right? Be upfront about what your budget is. You don't need to always go out for bottle service or those all-day brunches. Championing free and cheap can actually grab or gravitate people towards you, the tribe of people who want to do that as well. And I think the third thing is to automate before you celebrate. Make sure you're setting aside money for the savings, for bills. Automate all that before you go out and hit the social scene. And, Don did share with us in this episode how it was those kinds of strategies that actually helped him survive his financial life after leaving CNN, and how it prepared him to be able to start his own media company. It's a great Living Not So Fabulously episode, and make sure you tune into that. It's available tomorrow on your favorite podcast player or on yahoofinance.com.
Yeah, I love that, John and David. And like you were just laying out, you can catch the latest episodes of Living Not So Fabulously Wednesdays at 12 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. Coming up, why the newest summer vacation trend could be home swapping. That's next on Wealth. 90% of travelers are hoping to cut costs on their trips this summer. That's according to a new survey by home swapping platform Kindred. Some strategies include staying with friends or family, hunting for cheaper accommodations, or even opting for a staycation. I want to bring in Justine Palefsky. She is the co-founder of Kindred. So Justine, Kindred's latest data shows that travelers aren't canceling trips, rather they're adopting. So what does that say about consumer priorities right now, especially in the face of some of these rising costs?
Yeah, you're exactly right, Allie. I think we're seeing a confluence of factors right now that is resulting in a big change in the way people travel. As you mentioned, costs have risen quite significantly. Our summer travel report found that the cost of a summer vacation is $259 per person higher this summer than it was last summer. And at the same time, there's rising frustration. So 80% of people in the US result feeling frustrated with the options that they have available, whether it's too little space, they don't feel that they have the accommodations that are comfortable, especially for the cost. And those two factors together are resulting in a lot of people looking around saying, hey, is there a way to get creative for me to still be able to get my summer travel in without having to break the bank and having a better experience?
And to that,
go ahead.
No, I was just going to say, and to that point, 12% of travelers are now turning to home swapping options like Kindred. So for someone unfamiliar, how does that actually work? How much can the average traveler realistically save? It reminds me of the movie The Holiday, which is one of my favorites.
The Holiday is a wonderful movie. It's exactly like that. So Kindred is it's a social network for travel that helps peers organize stays at each other's homes. So instead of being a commercial travel marketplace, it's really for real people sharing their real homes with each other. Members do not pay one another to stay. They pay a small service fee and a cleaning fee. And removing out that nightly rate means that the average cost of a home swap is a fraction of the percentage of what it would cost to stay at a hotel or a short-term rental. So as an example, I actually just got back from New York City. I stayed there for a little bit over a week. I spent around $250 total, including my cleaning fee and all my service fees. So it really radically changes the equation for what travel can cost this summer.
Are you seeing this type of model resonate with different demographics? For example, with remote work exploding recently, are those workers really more interested in this type of travel?
Yeah, we're seeing home swapping resonate with a number of different consumer personas. One, as you mentioned, is certainly folks who are working remotely. They have more flexibility. They can work from a different city for a period of time, and they want to take advantage of that flexibility to squeeze in more travel. But we're also seeing home swapping really resonate with other groups, including families with young children. Actually, on Kindred, families is our fastest growing collection. We matchmake families with similar aged children, and they love home swapping because it enables them to stay in a bigger, more comfortable home with multiple bedrooms. And if you're traveling with an infant or a young kid, it is great to show up at a home that is already kid-proofed and has all the gear. So it's a way of making a family-friendly vacation more within the realm of possibility for families with kids.
You mentioned you've recently traveled to New York City. What are the most popular cities or destinations for home swaps right now? And are people using this to explore new places or stay longer in familiar ones?
It's both. Our most popular cities on Kindred right now are often the high-cost cosmopolitan cities like New York City, Paris, London, San Francisco. These are cities that have a tremendous price tag attached to them in order to travel. And so a lot of folks are traveling because they want to experience life in this other city. They're doing a mixture of business travel, personal travel, and vacation, and are using it as a way to experience life in a new city.
All right, Justine, innovative way to maybe have some different types of options out there for your travel plans. Thank you so much.
Thanks for having me.
Well, that's it for Wealth. I'm Allie Canal. Thank you so much for watching. And stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern.